Hi, Kelly Eckholt here to update you of the big events of the week. First thing to talk about is the Reserve Bank of Australia, which surprised markets by leaving their interest rates unchanged at 4.1%. The Reserve Bank of Australia still thinks that they may need to increase interest rates at some stage in the future, but they wanted to see some more data before deciding on that. Interestingly, they indicated that they were now comfortable with inflation taking until the middle of 2025 to get back within their target range, which is a bit different to the Reserve Bank of New Zealand, which is really looking to get inflation back inside the target range by the end of next year. The other big event was the labour market report for the June quarter, and that had something for everyone. The unemployment rate ticked up a bit to 3.6%, and wage growth held steady at relatively elevated levels. That will probably be of good news for the Reserve Bank, who will at least see that as indicating that inflationary pressures aren't intensifying in the labour market. But on the other side, employment growth was really strong, and the participation rate, the proportion of New Zealanders saying they're available for work, increased to a new record high. That runs against the idea that the economy is or is about to be in a recession anytime soon. And that means that there's probably still some risks of additional inflation pressures at some stage in the future. So what does all this mean for the bottom line for interest rates? Previously I'd been expecting a rate hike in the August monetary policy statement to 5.75%. I've had to push that out to closer to the end of the year in November. The Reserve Bank's had a fairly strong view that they were able to keep interest rates unchanged at 5.5% for the foreseeable future, and the flow of data that's come in the last couple of months probably wasn't strong enough to budge them off that view. So let's see what happens as we get towards the end of the year.